Welcome back to the channel. As always, if you're copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to look today at a stock called Take-Two Interactive Software, ticker TTWO. If you're a gamer, you will know this company because they have a portfolio of video games, with the most important one being the GTA franchise. So they own Rockstar, which is responsible for that type of game, as well as other franchises like Max Payne. And they also have Red Dead Redemption, LA Noire. But if you see, many of these franchises are becoming stagnant. LA Noire has been out of the picture for a long time. Same thing with Max Payne, Midnight Club, Red Dead Redemption is it was released quite a while ago. So at the moment, the thing keeping this company going is the Grand Theft Auto franchise, which is going to release its sixth game in autumn 2025. Other than that, what's keeping the company going is uh, the mobile section of video games, Zynga. Now, overall, if we look at the chart here, we see that the technicals look quite oversold and about to enter a correction phase. And I do think this is happening because, first of all, the stock has had a mediocre year, but just came out of a big rally. And in my view, this rally is not justified, and it's a wave prior to a further low. So we see here how we're getting lower lows and lower highs. Yeah. Now, in terms of valuation, this is one of the main reasons why I'm bearish about this stock. The valuation is almost at 60 times earnings, and it reached its absolute high of almost 67 back in June when I was already looking at this stock. Then the earnings came, and they weren't positive at all. So we have sales disappointing, EBITDA is just all right, but EBIT is down, EPS and EPS also disappoint. And in the meantime, this company has been negative on not only revenue, uh, for the most part, if you look at a company like this, digital, especially with this type of multiple, you would expect to see significant growth. But that's mediocre at best with the type of top line that we see here. And more importantly, margins have been contracting as well in recent times. And that's with the last quarter that had increasing revenues. EBITDA margin has also been shrinking. But most important of all is that the net income still is and has been negative for quite a while. So the company has been losing money for like more than a year straight. Yeah. And at the same time, we have debt increasing as it goes. So all these things don't make sense to me from a valuation perspective. And it seems to me that the potential of this massive Grand Theft Auto franchise has been reached already, and there's nothing else holding everything together. Now, looking forward, we see that sales have been revised down for the next 12 months, as it has been EBITDA, EBIT, and the company, if we look at it from a EPS versus price perspective, provides plenty of downside risk. So you see here how in January 2023 was trading at around similar levels, and then the gap starts broadening whilst the baseline goes down. So to me, that signals that there's plenty of downside risk here. A different way to look at it is the expectations, which again have been slashed for 2025 by a significant amount, as you can see. And remember, the GTA game will be released in autumn. So that means that from a financial year standpoint, most of the FY 2025 will be gone by the time that the game is even released. You also need to wait a few weeks probably till Christmas, till you see the sales rolling through, and they may be good. But I think in the meantime, the company has not much more to offer. At the same time, the analyst community, in my view, is too benign on this stock. So we have seen how expectations have been slashed. We have seen how the company keeps disappointing, and yet the average price target has remained just constant. As a matter of fact, the low price target and the high price target have been recently increased by the analyst community. And there seems to be a lot of consensus among them. So most of them have a positive to neutral view. And to me, this creates room for changes in fundamentals when the next round of earnings come around. So with all that, we have to ask ourselves what's going to happen. Earnings will be reported on the 8th of November. And if we look at the options chain, we don't necessarily need to get exposure to that, but we certainly can if we feel that's going to be a catalyst. Obviously, earnings report always provides room for catalyst. And if we look at the Novembers, we have a decent implied volatility. We look a little bit farther in December, and the volatility is actually even lower. So to me, this provides an interesting structure for a calendar. Perhaps enter the current price on 1-to-1 ratio on a calendar spread and potentially add at a later date. But I could see the stock dropping back, especially if we enter a sideways time in the market where the stock just keeps seesawing as it has been since the beginning of the year, really. We could see the stock back at 135. So depending on the timing for our entry, I wouldn't enter this right now just because I don't need more shorts at the moment. But if I wanted to enter now, this seems to be a pretty good entry point for a vertical. So that could be done too. We could take the 155s and sell the 135s on a 1-to-1 ratio, and that provides a decent structure. So let's see how that works. So buy 15th November and sell 135s. And there you go. Provides almost a 300% return. Hope you enjoyed the video. See you soon.